I don't have to tell you things are bad. Everybody knows things are bad. It's a depression. Everybody's out of work or scared of losing their job. The dollar buys a nickel's worth. Banks are going bust. Shopkeepers keep a gun under the counter. Punks are running wild in the street, and there's nobody anywhere who seems to know what to do, and there's no end to it. We know the air is unfit to breathe, and our food is unfit to eat. We sit watching our TVs while some local newscaster tells us that today we had 15 homicides and 63 violent crimes, as if that's the way it's supposed to be. We know things are bad, worse than bad. They're crazy. Everywhere is going crazy, so we don't go out anymore. We sit in the house, and slowly the world we're living in is getting smaller, and all we say is, please, at least leave us alone in our living rooms. Let me have my toaster and my TV and my steel-belted radios, and I won't say anything. Just leave us alone. Well, I'm not going to leave you alone. I want you to get mad. I don't want you to protest. I don't want you to riot. I don't want you to write to your congressman because I wouldn't know what to tell you to write. I don't know what to do about the depression and the inflation and the Russians and the crime in the street. All I know is that first, you've got to get mad. You've got to say, I'm a human being. God damn it. My life has value.
The United States government decides it needs some money, so it calls up the Federal Reserve and requests, say, $10 billion. The Fed replies, saying, sure, we'll buy $10 billion in government bonds from you. So the government takes some pieces of paper, paints some official-looking designs on them, and calls them treasury bonds. Then it puts a value on these bonds to the sum of $10 billion and sends them over to the Fed. In turn, the people at the Fed draw up a bunch of impressive pieces of paper themselves, only this time calling them Federal Reserve notes, also designating a value of $10 billion to the set. The Fed then takes these notes and trades them for the bonds. Once this exchange is complete, the government then takes the $10 billion in Federal Reserve notes and deposits it into a bank account. And upon this deposit, the paper notes officially become legal tender money, adding $10 billion to the U.S. money supply. And there it is. $10 billion in new money has been created.
But think of it this way. You deposit your money in the bank, and the bank then takes that money and it lends some of that money out. So if you were the only deposit in the bank, you would say, well, wait a minute, it's lent the money out. What if I want to withdraw all my money? It's not there anymore, which is true. It's not. A fraction of that money is now being lent out, and the bank can't access it easily. So actually, if you read the fine print of your checking account, it actually says that the bank is not obliged to provide you with all the money in your checking account whenever you actually want it. They can actually freeze you out of that account for a certain amount of time until they can get that money from the person they lent it to and return it to you. And, you know, if you read the fine print in the contract, no bank is contractually obligated to provide you with all the money you want whenever you want it.
There are three ways to make a living in this business. Be first, be smarter, or cheat.
Now, why isn't this a continuous problem where I want to withdraw money and it's not there? Here you get to a statistical phenomenon, which is called the law of large numbers. And that is that if enough people are depositing money in the bank, and if the bank is not lending all of it out, but lending a certain fraction of it out, then you can come up with a number when 99.999% of all the times where people want to withdraw money, they will actually get their money. The bank will always have enough money in their vault in order to provide it to you. And the bank can then take whatever fraction they have calculated and lend it out and feel pretty comfortable, because some people are withdrawing money, but then other people are depositing money. And almost never is the case that the bank has no money to give out.
So the exchange has been made, and now $10 billion sits in a commercial bank account. Here's where it gets really interesting. For as based on the fractional reserve practice, that $10 billion deposit instantly becomes part of the bank's reserves, just as all deposits do. And regarding reserve requirements, as stated in modern money mechanics, a bank must maintain legally required reserves equal to a prescribed percentage of its deposits. It then quantifies this by stating, under current regulations, the reserve requirement against most transaction accounts is 10%. This means that with a $10 billion deposit, 10% or $1 billion is held as the required reserve, while the other $9 billion is considered an excessive reserve and can be used as the basis for new loans. Now, it is logical to assume that this $9 billion is literally coming out of the existing $10 billion deposit. However, this is actually not the case. What really happens is that the $9 billion is simply created out of thin air on top of the existing $10 billion deposit. This is how the money supply is expanded. As stated in modern money mechanics, of course they, the banks, do not really pay out loans from the money they receive as deposits. If they did this, no additional money would be created. What they do when they make loans is to accept promissory notes, loan contracts, in exchange for credits, money, to the borrower's transaction accounts. In other words, the $9 billion can be created out of nothing simply because there is a demand for such a loan and that there is a $10 billion deposit to satisfy the reserve requirements.
In addition, in more modern, sophisticated, complex financial markets, the bank, if it is in a liquidity situation where people are withdrawing money and they don't have enough money to provide, they can go out and borrow money on a short-term basis to provide the withdrawals. That's called fractional reserve banking. It's the idea that of every dollar you deposit, a certain percentage of that is lent out.
Now, let's assume that somebody walks into this bank and borrows the newly available $9 billion. They will then most likely take that money and deposit it into their own bank account. The process then repeats, for that deposit becomes part of the bank's reserves. 10% is isolated, and in turn 90% of the $9 billion, or $8.1 billion, is now available as newly created money for more loans. And, of course, that 8.1 can be loaned out and redeposited, creating an additional 7.2 billion, to 6.5 billion, to 5.9 billion, etc. This deposit money creation loan cycle can technically go on to infinity. The average mathematical result is that about $90 billion can be created on top of the original $10 billion. In other words, for every deposit that ever occurs in the banking system, about 9 times that amount can be created out of thin air.
Around the block.
Name of the game? Move the money from your client's pocket into your pocket.
What is actually giving this newly created money value? The answer? The money that already exists. The new money essentially steals value from the existing money supply. For the total pool of money is being increased irrespective to demand for goods and services. And as supply and demand finds equilibrium, prices rise, diminishing the purchasing power of each individual dollar. This is generally referred to as inflation, and inflation is essentially a hidden tax on the public.
Look, more jobs means fewer people looking for work, means it's harder to find good people to fill those jobs, means you gotta raise wages to get them, means inflation goes up. You got it?
What is the advice that you generally get? And that is inflate the currency. They don't say debase the currency. They don't say devalue the currency. They don't say cheat the people who are saved. They say lower the interest rates. The real deception is when we distort the value of money, when we create money out of thin air. We have no savings, and yet there's so-called capital. So my question boils down to this: how in the world can we expect to solve the problems of inflation, that is, the increase in the supply of money, with more inflation?
The fractional reserve system of monetary expansion is inherently inflationary, for the act of expanding the money supply without there being a proportional expansion of goods and services in the economy will always debase a currency. In fact, a quick glance at the historical values of the US dollar versus the money supply reflects this point definitively, for the inverse relationship is obvious. $1 in 1913 required $21.60 in 2007 to match value. That is a 96% devaluation since the Federal Reserve came into existence.
So increased income allows increased borrowing, which allows increased spending. And since one person's spending is another person's income, this leads to more increased borrowing, and so on.
In fact, only 3% of the US money supply exists in physical currency. The other 97% essentially exists in computers alone. Now, government bonds are, by design, instruments of debt. And when the Fed purchases these bonds, with money it essentially created out of thin air, the government is actually promising to pay back that money to the Fed. In other words, the money was created out of debt.
The true value is in the debt that it creates. You control the debt, you control everything.
I want you to get up now. I want all of you to get up out of your chairs. I want you to get up right now and go to the window, open it, and stick your head out and yell, "I'm as mad as hell, and I'm not going to take this anymore!" No! Stick your head out of the window, open it, and stick your head out and keep yelling and yell, "I'm as mad as hell, I'm not going to take this anymore!" Just get up from your chairs right now. Go to the window.
Where are you going? I don't want to see if anybody's
go
yelling.
To the window, open it, and stick your head out and